Investing internationally is important to diversify your portfolio. Having a US-based international fund is good enough for most of us simply because the US is a good representative of the developed markets. Within the US market, one can opt for the broader S&P 500-based funds, or if you're willing to take a greater risk and accept higher volatility for potentially better returns, then Nasdaq-based funds can also be considered. Remember, when you invest in US indices, it's not just about getting a geographical diversification in your portfolio. It's also a play on rupee depreciation, which over the years has been beneficial for Indians investing in international markets. Nowadays, there's another interesting option available for those looking for aggressive investments in US tech stocks, the NYSE FANG Index. Though it is less diversified than the Nasdaq 100, it's still comparable as both of them focus on tech stocks heavily. Let's do a comparison of the two. The Nasdaq 100 index is primarily tech-dominated. The index is made up of the 100 largest US and non-US stocks. Some of the world's most innovative and famous companies, the likes of Apple, Google, Amazon, and Facebook, are all part of it. The NYSE FANG Index is an equal-weighted index made up of 10 technology-based stocks. The acronym FANG, F-A-A-N-G, stands for Facebook or Meta now, Amazon, Apple, Netflix, and Google. In addition, there are 5 tech-enabled companies in the index: Tesla, Microsoft, Nvidia, Alibaba, and Baidu. The weights change due to price movements, but once every quarter the weights are reset to 10% each. Here are a few points about the difference between the two indices. 9 of the 10 FANG Index stocks are also part of the Nasdaq 100. So basically, the Nasdaq contains nearly 90% of the FANG Index plus 91 other stocks. Now, Nasdaq 100 is more diversified than FANG+, but it's still a lot less diversified if you compare it with S&P 500 index. And what's the weight of the FANG+ stocks in the Nasdaq 100? It's around 45-46%, though it changes on a daily basis. Since the Nasdaq 100 itself is a tech-heavy index and FANG+ is fully tech-oriented, both might come under high-risk category. Due to its heavy concentration in just 10 stocks, FANG+ is far riskier than the Nasdaq 100. Given the concentrated nature of FANG+ index, it has beaten Nasdaq 100 hands down historically. But there's a caveat. The index opened only in 2017 and has backtested data only from 2014. So there's not much of reliable past data to pick between the two. But if you do look at the historic data, then definitely FANG+ has outperformed the Nasdaq fairly easily. But remember, past performance may or may not be repeated in the future. Some say that FANG stocks are the growth engine of the Nasdaq, and it is true to an extent. But this also means that if things do go wrong for Nasdaq 100, like the tech bubble burst of the 2000s, then it can go a lot worse for the FANG+ index due to its extremely high concentration in just a few tech stocks. And now the big question. Should you invest in FANG+ index? The NYSE FANG+ is an interesting play on getting exposure to the high-growth basket of the world's biggest tech giants. But with just 10 stocks, it's more of a basket of FANG and a few other tech stocks for the ease of exposure and not exactly a diversified index. Nasdaq 100, on the other hand, is much more diversified, though still a bit less than S&P 500. If you're particularly passionate about the FANG theme, then of course you can consider the FANG+ index for a small exposure. If not, it is far better to diversify your investments in the US markets via the S&P 500 or the Nasdaq 100. Or if you want and are willing to complicate things a little bit more, you can consider mixing the S&P 500 and the NYSE FANG+ index. That way, you can maintain an overall diversified portfolio by investing in the S&P 500 and give an additional push to high-growth tech titans via the NYSE FANG+. Another way to invest in the US equities is via ETFs based on the Nasdaq 100 and FANG+. There's no restriction on buying these ETFs as they trade on the exchanges, but one must be careful while investing in them. At the time of buying these ETFs, do check the NAV and price individually to make sure there's not too large a difference due to liquidity issues. And of course, if you want to know about the direct ways to invest in the US stock market, check out our video. Link is in the description. And please don't forget to like, subscribe, and share.